Here's what's coming up on the Peak Financial Freedom Show with Jim and Dan.
We got our excess cash flow of $1,800 a month, which was an extra $21,000 plus per year of extra cash flow above her budget, so she could take that extra trip.
And it's going to contractually guarantee after 5 years they're going to get 9.78% per year guaranteed for as long as they live of the original investment. So if they put $1 million in, they're going to get $97,000 per year guaranteed for life after that 5-year deferral.
The client gets everything they want, they get it in writing, they understand what they're doing, and then when you actually see this diagrammed out, they say, well listen, I finally understand my money and why I should put money in each one of those buckets to accomplish the goals I want in retirement. And it makes it much easier for the client to accept the fact that, hey, I get it, and I know why I'm doing this.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hi, welcome to this week's show.
We have 30 minutes of great information designed just for you.
Don't go anywhere, get comfortable, because the show starts right now.
Hi, and welcome to this week's Author's Corner. As usual, I'm here with Jim and Dan. They are TV personalities, radio talk show hosts, and best-selling authors on Amazon.com. Guys, today we're going to be talking about how do you know? Dan, my first question is for you. And I have to imagine, I'm going to preface this with, how great does it feel when you get to tell somebody in your office, couple or individual, yes, you can retire? So the question is, how do you know if you have enough or a plan or a program that you know you can retire well?
Sure, I think to answer your first question is, that's really why Jim and I are in this business. It's to be able to help people who have done a great job of saving money, now retire and safely protect those dollars and use those dollars to produce the income that creates their lifestyle. And hardly any of them know they've actually succeeded. It's amazing. They don't know they've succeeded. And we're spoiled because we get clients that have saved $1 million, $2 million, $3 million, $5 million of assets, and they still feel poor and don't think they've succeeded. And you don't know that you have enough saved for retirement based on the amount of assets you have, which is what Wall Street wants. You know, it's like, have you hit your magic number kind of thing. Well, no one knows what the magic number is. You have to create a retirement budget, and the budget tells us each month how much income you need to pay for every single cost you have, including travel, including gifting to the kids, for pets, for hair, for makeup, for nails, everything. We have to know what that number is. Then we design an actual written plan. And the written plan now shows how you should allocate your assets to have the amount of risk that gives us the chance to get your income, what your income is going to be on an annual basis, what your income will be per month, how much tax you have to pay, and it comes up with a net income number each month that you know you have in your hand. So if your net income is $10,000 and your budget $7,000, you have $3,000 of net excess money. And we think net excess money on a monthly basis, Jim, is one of the most important things.
The key, Mark, is that by going through comprehensive planning with clients, not just investing your money, but taking the time to diligently understand everything in order for this plan to work. I say this with a great deal of confidence. We can radically change somebody's life when we do it every day. This is not arrogance. It just means that we take the time to go through this process to develop an income plan, a tax plan, a legacy plan, a risk plan, a fee plan. All this stuff gets developed into a plan written, signed by Dan and I, to make sure that the client understands what we're doing before we place any money in any assets.
Jim, let me ask you as a follow-up. When you're working with clients, how important is it for them to maintain their lifestyle? Or some say, hey, I'll cut back a little bit, but for the most part, people want to maintain their lifestyle. Is that a fair statement?
Well, yeah, I mean, the clients we deal with, they've done a great job saving money, and they've had most cases, a lot of assets. They don't want to go down in their lifestyle. They want to spend more money. They want to travel. They want to do those things they dreamed about when they weren't retired. So they look at their life expectancy. They have, if they're 60, they have 25 years left of good years. They want to spend that money, but they're afraid to spend it because they've been savers. We have to show them through comprehensive planning how they can actually achieve those dreams.
One of the books we wrote before, if you remember, had a chapter in it called We Give You Permission to Spend Your Money. Because people that have saved money, they become really, really good savers and they love it. Well, then when you tell them it's okay to spend the money, it's almost like you're telling them something that is like the worst thing in the world, even though that's why they saved the money for in the first place, was to be able to spend it and have a wonderful retirement.
That's such a key point. I mean, we really have to almost nicely argue with clients. We have to change their mindset. You you've done a great job for 50 years or 60 years, you've saved so much money, it's wonderful. We're going to show you how to spend it. It's hard to get them to think that way, but when you put together a plan, they'll start to see it.
Well, and you got to ask them, what did you save the money for in the first place? And then they go back to when they were 20 or 30 and they go, oh, I saved it so I could spend it at retirement time, as long as we can help them understand that they don't have to worry about it running out.
Yeah.
You know, and I imagine that is a very difficult mindset to change. Do people ask you, what percentage can I take out? And that's probably not the proper question.
Oh, no,
right?
they do, because consumers, retirees, soon-to-be retirees, they don't know what questions to ask, so they'll just say it bluntly. How much can I take out? What percentage can I safely take out? I think what you're referring to is what are called safe withdrawal rates. That's what the industry calls it. It just means how much can you safely take out of your assets without worrying about running out of money. And that's drastically reduced over the last 40 years. Like back in 1980, the safe withdrawal rate was 6%, meaning you could take 6% out of your accounts and you had a 95% chance it wouldn't run out. But what happened after that, Jim, in 90, 2000, 2010?
Well, interest rates drop, market volatility went up, and now they're saying you shouldn't take out more than 3% and maybe even 2% out of a conventional portfolio.
Half as much.
Yeah, but that's why we just don't use conventional portfolios, because we be restricted to those rules. We're using different asset classes. We're introducing different strategies so we can get more income out on an annual basis, and in many cases, if not most cases, that income won't run out either.
Yeah, we just did a case for an individual where if the safe withdrawal rate is 3%, in this case they had 5 years before retirement, they're going to put money into one of the plans and it's going to contractually guarantee after 5 years they're going to get 9.78% per year guaranteed for as long as they live of the original investment. So if they put $1 million in, they're going to get $97,000 per year guaranteed for life after that 5-year deferral.
Awesome.
That's pretty good.
Dan, Jim, thanks so much. Hey, if you want more information about anything we spoke about here today, give us a call in the office. Pick up that phone right now, 916-452-7325, or go to our website. And don't go anywhere. We'll be right back.
Hi, I'm Jim Files, CEO Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. We're offering you a free, worry-free retirement roadmap, including a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all free, no pressure, no obligation, guaranteed. There's no risk and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
In this week's segment of We Fix Your Money, you're going to meet Fran. She's in her mid-70s and is recently widowed. But she's still working. She's scared about making financial mistakes like taking too much risk or running out of money in retirement. Now over to Dan and Jim to tell you how they help Fran.
Thanks, Mark. We're so happy to be here to present our hypothetical case study about Fran. She's 75. Let's assume her husband died 1 year ago. And she's still working. She's working as a realtor, commuting all the way back and forth from San Francisco. She lost her husband's pension, which is devastating. She does get Social Security. She has about $1.7 million of assets. She's had a broker for 25 years, and she thinks of the broker as a friend, but she's never had a plan. So she's worried because she has to do this by herself, and she wants a written plan now. She wants to retire as soon as possible. She doesn't want to have to continue to work as a realtor and get stuck in traffic jams day after day. She wants to replace her lost pension. She knows she has to, otherwise she won't have enough money to spend. And she needs $100,000 of income. She wants to stop worrying about so many things. Number one, having to sell her house. Her broker said to sell her house and then she'll be fine. She doesn't want to sell her house if she doesn't have to. She's worried about taking care of money alone, and she's worried about suffering big losses, and because of that, her money running out at retirement. Kind of the same thing a lot of people worry about.
That's exactly right, Dan. And because we know now a lot about what this client wants, like we would know for every client before we start the planning process, we were able to put together a current allocation and risk assessment plan. This lady had $40,000 in the bank. She had $1.66 million invested in the markets. She had no money in principal protection or lifetime income bucket. We upped her bank money from $40,000 to $100,000. We thought she needed that extra liquidity and that extra safety. We reduced her growth bucket because she wanted very specific things. She wanted a reduction of risk and she wanted increased income. So because of that, we put $1.1 million into the principal protected and lifetime income bucket, same amount of money, just to restructure. We lowered her risk significantly. She was at a 30% risk factor, which means if the market dropped by 50%, she would lose about 30% of her money. that would mean she would lose about $513,000 of value, and she would need a 43% rate of return to make up that 30% loss, which was substantial and very scary for her. When we remodified the plan, we reduced that risk from losing 30% down to only 3.5% under the same scenario. That would mean she would be down about $60,000, not $513,000. And the key here, we only need a 3.6% rate of return to make up that 3.5% loss, which is much more achievable in order to get her back to even if the market goes down in the future.
And you might see yourself in these numbers because a lot of times people have a little bit of money in the bank, a lot of money in the growth, but they don't realize they have so much risk. And this was actually a 30.2% risk factor initially is actually low. A lot of people come in, you might be sitting on a 40 or 50% risk factor. Well, in this case, if we can reduce the recovery gain needed from 43% down to 3.6, it means we reduced her risk by over 90%. And can you imagine what she felt as far as the anxiety lesson at that point by having so much less risk in her portfolio? And we did this because we have to build an income plan, and we want to make sure her fees are under control. Well, the income plan currently was her taking $20,000 of income off her assets, which wasn't enough, and she had no guaranteed lifetime income. So as we restructured the portfolio, as Jim explained in the last slide, we now created $70,000 of income per year just from the assets, with $55,000 of the $70,000 being guaranteed for as long as she lived, and we used about $1.1 million to do that. What was the perfect plan for her? Because again, this is what she wanted. We designed the plan to meet what her financial goals were, especially her income goals and her risk goals. And then we did a fee analysis. She wasn't bad before. She was paying about 2.21% in total fees, the fees she saw and the fees she didn't see. With the new plan, though, we're going to get her fees down about 1%. We're going to get her fees down to 1.21%, which means over the next 15 years, she can plan to have a projected fee savings of over $250,000 that either stays in her pocket as income or is passed on to her beneficiaries. So it's just a great way to do this, which then allowed us to go to the next step, which is to show what is her net income going to be.
Well, by architecting the plan so far, we've increased her income substantially, we reduced the fees, and we were able to get her enough gross monthly income, which is $8,900 in her example in green. Estimated federal and state taxes, $1,500. Net after-tax income per month, $7,400. She had a budget of $5,600, which included all of her budget items, including travel. We got her excess cash flow of $1,800 a month, which was an extra $21,000 plus per year of extra cash flow above her budget, so she could take that extra trip. She could buy a car for cash in maybe 2 years or 3 years by saving that money up. These were things that come up in life, and if you don't have that excess cash flow built in your plan, you suffer in retirement, Dan.
When you look at this particular lady, this circumstance, if she has $21,000 more to spend each year, she could take the whole family on a trip every single year, not just once, but she can do it this year, the following year, the following year, the following year, and really increase all the memories she's going to have with her family, which they'll love that. They don't want her to leave just a little bit extra money to them when she's gone. They want to go on all those family trips because it's good and fun for them as well. So after we did the plan that showed she was fine, she'll have enough income, more than she needs each month, she then worried about, well, what am I going to be able to leave to my beneficiaries? What's my legacy? So we do a calculation showing, what if your assets only earn 4%? What if your bank earns 1%? What if your real estate appreciates at 1.5%? We think those are very conservative numbers. And what if Fran or you spend all of your income throughout your lifetime? You don't save any of it. At age 90, then, she's projected she would have taken out from age 75 to 90, $1.15 million of income, and she spent it. And then at age 90, if her assets in her portfolio only earn 4%, the bank earns 1%, real estate earns 1.5%, she's still by accident going to leave about $3.2 million to her beneficiaries. So it's a great plan. She gets to use the income she needs to live the wonderful retirement, and she's still going to be able to leave a lot of assets over to her beneficiaries.
So Dan, by taking into consideration all these objectives that this lady wanted, she now feels totally confident with her plan. We put together a written retirement income plan. She can retire immediately, which solved a lot of her worries. We replaced the pension she lost when her husband died. She can stay in her house, which was, she was so excited over that. We reduced her fees. We got her an extra $20,000 of excess cash flow, and she was able to leave money to her children and her grandkids when she passes on, which was a main concern of hers when we're putting the plan together for her.
Well, for Fran and for everyone watching, this just shows you can attain. There's a possibility of attaining all of your financial goals and objectives simply by creating a plan that allows you now to state what you want and then allowing us to redo the numbers and redo the finances that gives you the highest probability that all your goals will be achieved. Mark, back to you.
Wow, what great results from a great plan. Your situation may not be exactly like Fran, You may be married or retired, but you can see how planning can help you attain your goals and alleviate some of your worries about money. If this is something you'd like help with, give us a call right now. Pick up the phone, 916-452-7325, or visit our website. Now stay tuned for a great complimentary offer.
Hi, I'm Dan Ahmed, president of Peak Financial. We have a great free offer for you. We're offering you a free, worry-free retirement roadmap that includes a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all for free. No pressure, no obligation, guaranteed. Call the phone number on the screen or go to our website to claim your free offer. You have nothing to lose, there's no risk, and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome back to the program. Now let's listen in on the Peak Financial Freedom Hour with Jim and Dan.
Jim, great to be back for this week's radio show, Peak Financial Freedom Hour. And we're going to talk about some questions we've heard in the past from people and try to answer them, because probably a lot of people listening now have these same types of questions. Might not be the exact same case type of study, but I think it'll fit in really well. So why don't we start with Annie, age 64, single and retired. She doesn't want to take much risk any longer, but her broker just doesn't listen. And he makes her feel dumb for feeling scared. I've lost a lot of money in the past, so I'm very worried. I feel intimidated by my broker. He kind of acts like my dad. What should I do? Well, first of all, we've seen this a lot.
All the time. Yeah, all the time. And she should be scared, right? If she doesn't have a plan in place and she doesn't understand how much risk she has, how much she could lose, if her broker makes her feel dumb, or even if the broker doesn't make her feel dumb, it sounds like she leaves that office and doesn't understand what the broker even talked about maybe. And maybe it's not that, but it's just that she's intimidated and doesn't understand it.
Well, maybe handle this then, because it really said, what you just said, the broker doesn't listen.
Yeah, he doesn't listen, and because the broker knows more about money than the client does, the client becomes intimidated and doesn't know the question to ask. And in order to do this properly, particularly if she's single and she's frightened because she's by herself, is that she has to have a full plan in place, and that broker has to, or some advisor has to sit down with her and walk from A to Z to make sure that a plan's put in place to accomplish all those scares. She's frightened about things, definitely. But you can do that, Dan.
Well, it's our philosophy to be educators, to be mentors, and help walk someone, coach them through the entire process of building a written plan. We give them a free second opinion on where they're at, educate them on that. Then we build an actual plan that'll show how much income they're going to receive for the rest of their life. We're going to show for the next 30 years, each year, where each income source comes from. They have no idea where they're going to get their income from. They see that, they're like, oh my gosh, I'm not as worried. Then we're going to show them how much tax they're going to pay, and we're going to show them each month what their net income is after taxes, so they know how much they have to spend. We're going to put their risks down. She said she's taking a lot of risks and doesn't want to do it anymore. We're going to show her in writing what her projected risk level is and her fees, and if she wants to leave money to beneficiaries, we're going to even show how much money possibly in the future she can leave. So with the plan, Annie, I think we can definitely help someone like that. How about Martha? She said, I've heard you on the radio talking about using 3 buckets to allocate my assets. I have about $2.3 million saved, and I want to manage 300 of my own assets and have you manage the rest. Can your buckets still work? And I'd say, yes, we have probably 1 out of 5 clients that still want to manage some of their own money. And we then manage really the more conservative section, and they manage the more aggressive, which is kind of opposite, because usually advisors manage the risky side, the clients are more conservative. We do it opposite. We're going to create a more conservative model than what she's probably going to invest in. She's probably going to do individual stocks. Maybe she likes Tesla and Apple and Amazon. But when we talk about our 3 buckets, you look at 3 different categories of assets you can use the money for. One is going to be liquid bank assets. We're going to tell her she needs to have a considerable amount of money in the bank to sit there so she can use it and it's safe and there's no fees. The second asset group is going to be her growth assets, because we want her assets to have some growth potential so that it can have more money in the future, but also help hopefully to fight inflation. And the third bucket is going to be the principal protection and guaranteed lifetime income bucket. And if you separate out these buckets, now you get liquidity, you get growth opportunities, you get income and safety, and you get what a client really needs.
Yeah, and she has a 4th bucket, right? The 4th bucket is her own money. She's going to manage $300,000. But you put together a plan like that, the client gets everything they want, they get it in writing, they understand what they're doing. And then when you actually see this diagrammed out, they say, well, listen, I finally understand my money and why I should put money in each one of those buckets to accomplish the goals I want in retirement. And it makes it much easier for the client to accept the fact that, hey, I get it, and I know why I'm doing this.
Definitely. Like in her case, if she manages $300,000 of assets aggressively, we take that off the table for income. We use $2 million to create income. We might be able to create $100,000 of income in that plan, plus her Social Security and pension if she has it. She's going to be fine, and she can take a little bit more risk.
Exactly.
There's a lot of people out there probably feeling this way. We'll be glad if you're thinking about any of the things we talked about fits your situation. We'll give you a free second opinion. Just give us a call, or you can go to our website and we'll sit down with you, talk to you, hopefully put you in a better position so you don't worry about your money so much.
Thanks, guys. That was some great information. Don't go anywhere. We'll be right back.
Hi, I'm Jim Files, CEO of Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. We're offering you a free, worry-free retirement roadmap, including a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all free, no pressure, no obligation, guaranteed. There's no risk and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
There is so much conflicting advice and confusion on how retirees should invest their money for success. Most of the recommendations seem to be focused on how to grow your assets to have the largest potential value, even if there is a considerable amount of risk involved. Today on Peak University, Dan and Jim are going to discuss whether or not they agree with this philosophy.
Thanks, Mark. And yes, it's conflicting advice all over the place. Internet, TV, radio, advisors, and people are very confused. Should they grow their assets without regard to risk, or should they be more conservative and generate a high level of income? And when it comes to retirement planning, you really have to think about focusing on income. So we then ask the question, how can you measure the financial success you will have at retirement? And if you look at Wall Street, you look at the typical traditional financial advisor, Jim, they're going to tell you always to base your success on your magic number, how much money you have, this total asset base that you've now accumulated over the last 30 years. That dictates your success. We completely disagree with that, Jim. We agree that financial success in retirement can only ever be measured by income, because income drives your lifestyle at retirement time.
That's right. Income is a goal. You have to understand you're at a different age, you're at a different sequence of life events, and you have to make sure that your assets have grown so now you can generate income off those assets, Dan.
And income is important because when you're working, you get your paycheck. So you go to work, you get your paycheck, no problem. At retirement time, you're not getting the paycheck. So is the value of your assets more important, or is the income that's being driven off those assets more important? And the correct answer is the income. Let's do a great example. Let's measure your financial success in retirement by looking at, it's not about the assets, it's about your income, and it's about what we call your net monthly excess cash flow. That means you get your gross income, you pay your taxes, you have a net income, you pay your budget, and now you have an excess amount every month coming in. That's how we judge how financially successful you are. Not based on how many assets you have, but how much extra on a monthly basis you have. Think about that. The more you have net every month going back into your savings account, the more you're going to feel secure. So let's look at case examples. The Johnsons, they have $5 million of assets saved for retirement. They've done awesome. They have $150,000 of total retirement income. They're at a 16% overall tax bracket. They're generating $12,500 of gross income. They're paying $2,000 in taxes. They have $10,490 net after-tax income every month. Their budget's $10,000, so they have $490 excess cash flow to spend each month. And a lot of people say, oh my gosh, that's great. They beat their budget. They did beat their budget, but by such a small amount, there's no way that's enough. The whole goal is maximizing your net excess cash flow. Let's look at now the Smiths. The Smiths now have only saved $4 million, so they have not achieved as much as the Johnsons, but they're generating $200,000 of total income. Their taxes go up a little bit, but only from 16 to 20%. Their gross income is $16,667 per month. Their net is $13,406. With that same budget now, they have $3,406 more to spend, Jim, than they need. How would they feel?
It's awesome, right? People don't think they can do this, but continue on, Dan, because it even gets better.
Yeah, now let's look at the Joneses. They only have $3 million saved. They have $2 million less than the Johnsons, but the Joneses are doing a smart income plan. They're generating $250,000 of gross income per year. Their taxes only go up to 22%. Their gross income per month is $20,833. Their net income is $16,156. That same budget of $10,000 gives them $6,156 more to spend per month than they need, and that's after paying taxes. How would you feel if this was you And every month you paid your taxes. You paid for your budget, which includes travel, real estate taxes, food, medical, all those things, and you had $6,156 more in your hands at the end of the month after paying all these bills, Jim. How would you feel?
It's awesome, and in retirement, again, we're talking about income. Everybody knows in real estate there's three main rules, right? Location, location, location. Well, in retirement, there's three main rules: income, income, and income. Because again, you have a certain life expectancy. You have to figure out how to take those assets and generate income. And let's give an example of that, Dan.
Sure. And income, remember, drives your lifestyle.
That's exactly right.
Would you rather be like the Johnsons, the Smiths, or the Joneses? Who do you want to try to keep up with? And we think you need to try to keep up with the Joneses.
So let's give you an example. We'll give you a case study here. Married couple, age 65. Income is guaranteed to be paid for their entire lives, husband and wife in this example, regardless of how long they live, regardless of whether the stock market crashes once or 10 times, and regardless of how much your asset earns. Isn't that a key component, Dan, is being able to do all this and not worry about the stock market?
100%, because this is what people want. They just don't know they can do it because it really never has been explained to them properly.
Yeah. So we'll give you an example here. Let's just assume you have $1 million to invest, investable assets, and you decide you're going to retire in, let's say, 5 years. Or you might want to retire in 2 years. There are certain financial instruments we use or consider inside of an income plan that allows us to get this guaranteed income and know exactly what we're going to be paid at certain dates and time.
Well, just as important, you could retire right away, Jim,
yes,
immediately.
You could. Exactly. So if you retired right away, in this example, if you're 65, married couple, you could get $63,000 of guaranteed lifetime joint income regardless of how long you live, regardless of stock market crashes, regardless of interest rates, which is the 6.3% mathematical payout of your original $1 million, Dan. And if you waited 2 years, you could get $69,215. But let's say you go out to 5 years. Let's say you're ready to retire and you want to start your income in 5 years. Well, we know contractually in 5 years, you're going to have your value of your income portfolio, not for a lump sum withdrawal, but for your income calculation is $1.45 million. And they will pay you on a joint basis $97,875, which is a 9.78% payout of your original $1 million. Dan, you cannot do that with a managed portfolio. It's impossible.
You can't take out 9.78% of your asset base. And if you can imagine now, go back to that lump sum. If you did have $1.45 million in a lump sum, would you rather have $1.45 million in a lump sum, or would you rather have almost $100,000 of income guaranteed for as long as you live? And everyone's going to opt for, I'd rather have $100,000 of income guaranteed for as long as we both live. The longer you defer it, the more you get, but the goal isn't to defer it forever. Right. The goal is to defer only until you get to that income source. If you say you need $100,000, we defer it, we start taking income 5 years later, and you're guaranteed $97,875 to be paid to you for as long as you live. Back to you, Mark.
Thanks, guys. In retirement, it makes perfect sense to focus on income because that's what will drive our lifestyles. And guaranteed income seems even better. If there's something you would like to know more about, hey, give us a call in the office, 916-452-7325, or go to our website.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Thanks for watching this week's show.
And if you want more information about anything we talked about here today, give us a call in the office or go to our website.
And remember, at Peak Financial Freedom Group, we fix your money.
The preceding program is sponsored by Peak Financial Freedom Group.